what is what are the components of financial diligence? We think about it so often, how it impacts deal success. What does it really look like? Why is it important? Um, how financial diligence ge- translates into real dollars you can save during this business acquisition process. Hopefully, we can unpack just a little bit of it today, but those are some things to think about. So the purpose and importance of diligence, it's really four buckets: risk mitigation, identifying, financial risks, red flags, and avoiding costly surprises is key. Ultimately, your diligence speaks to the valuation you place on the company. Is it accurate? Is it the price you're paying reflect the true value of the business? With knowledge is power, so enables you to make informed decision making. If you have a transparent view on the company financial status, you can be confident when you do have to have those tough conversations in working capital negotiations, purchase price negotiations, etc. And then diligencing a company before you step into the shoes of an owner really lays the groundwork for post-acquisition planning, and can be super helpful as you understand the company's financial operations and you put together a game plan of what is it going to look like when I come in as a new owner. Before we continue on, I'll do a Q&A at the end. So if you do have questions, I'll get to as many as I can at the end. You can just put them in the Q&A box, and we can talk about them at the end. So thank you. So this is an overview of the financial due diligence process as a whole. This is a nice visual. So if you want to take a picture of this, now's the time. It gives you really a 7-step process of what I think financial due diligence should look like and the key buckets to focus on. So really, step 1 is the preparation and planning. This involves setting up the engagement, data collection, which is financial data request list, and understanding, meeting the key personnel. This typically is in the first week of financial due diligence, which is typically a 4-week process. From there, you get into, I like to call it the meat of the analysis, which is analytical procedures, income statement review, balance sheet review, and number 7 are the very technical analysis of diligence, such as quality of earnings, which is understanding and calculating an adjusted EBITDA number. We're going to cover that later, so just wanted to highlight it. The second one is net working capital analysis. We're going to double click on that later. And the third piece is a proof of cash or proof of revenue analysis. I'm going to walk through those 3 analysis on real deals just in a few minutes, so stay tuned. These are the 5 components of financial diligence. I will say there are over 20 to 30 different procedures that you could do and call it financial diligence, but these are just the large buckets. So for those doing smaller deals, and if you've ever heard the word Q of E light, Q of E light speaks to an ETA or Main Street term for a lower cost due diligence option, which still covers the key areas. If you can successfully complete these 5 buckets, you may not need a comprehensive diligence, but still gain that risk tolerance and understanding of the business. So that's why I bucketed these 5 out. When we think about, for those who are under LOI and actively searching and even started searching, take out your phone, screen grab, take a snippet of this timeline. This is what it looks like for a typical LOI due diligence. It starts with a signed LOI. Two of you said you have that, which is great. From there, you're looking at a 90 to 120 day process, which ultimately gets you to the closing table. You'll notice there's a lot of pieces to this. So I'll give you a moment just to take a quick screenshot of this, and then we'll continue on. So the green piece, the financial due diligence, is what we're going to cover today. This typically occurs right when you get that signed LOI. Additionally, during those procedures, during the financial due diligence piece of this timeline, you may start to reach out to SBA banks and begin the underwriting process, conduct tax and operational due diligence. Typically, these can work in parallel. The one item I like to call out is this legal due diligence, which, depending on your budget, can be started at that signed LOI period. But at the bare minimum, you'll need to bring in a M&A attorney to draft a purchase agreement, which is typically in those last 30 days of the diligence timeline. Some diligence are 90 days, some are 120. This chart does a good job to show the differences of each of those buckets and service providers you'll need to get to the closing table. So due diligence, I like to use the term trust, but verify. Trust what, Pat? When you speak to sellers and they provide financial data, it's best practice, in my opinion, to trust what they're saying, what they provide to you is accurate, or to the best of their ability, they're trying to be accurate, but verify. Verify the documents, verify what they're saying is true through these due diligence procedures. If you use the trust but verify approach, is not only going to make it easier for you to conduct diligence, and you'll be able to maintain that positive relationship between you as the buyer and the seller. If you come into diligence thinking everything the seller gives you is incorrect because they're being intentional or fraudulent, it's very damaging in diligence, and you may actually lose good deals if you approach it that way. So, working capital valuation. This is that one of these specific analysis I'm sure you've heard of. The working capital evaluation really it speaks to a few buckets. The objective of it is to analyze the company's liquidity and the short-term and really average financial health of the company, and what does a normalized working capital look like in order to continue maintaining the business operations during the transition period. I like to use the analogy, think of working capital like gasoline in a car. If you purchase a new car from someone you met at a third-party location or a parking lot, if there was no gas in the tank at the time of transaction, when you came to buy the car with money, cash, etc., you wouldn't actually be able to drive it home. What would you need to do? You would need to go to a gas station, pay money out of your pocket to maintain the operations of the vehicle. This is a very simple concept, but think working capital like gasoline. If you assume a new business and you are not provided with the working capital in the form of accounts receivable and other items you expect to get cash from, you can't continue running the day-to-day operations of the business and meeting payroll. So it's very important that you understand, one, that working capital is included in your deal, and two, you get an appropriate amount. So let's dive in. So this is a screenshot of a working capital analysis I just conducted. Essentially, what you can do is take the company's reported balance sheet and determine the current assets minus the current liabilities equals the net working capital on a reported basis. From there, you want to pull out what we like to call in financial due diligence is working capital adjustments. Typically, transactions are on a cash-free, debt-free basis. What does that mean as it applies to analysis? If you look at adjustments A and B, you are removing the cash and cash equivalents from total current assets, and you're actually subtracting it from the net working capital reported. And this will lower your working capital number. On the flip side, your loans and accrued expenses, etc., these represent debt-like items. Again, the transaction, this is for transactions that are assumed to be on a cash-free, debt-free basis. So you need to pull out debt-like items or other items that may be sitting in this total current liabilities amount. Remember, net working capital on a reported basis is current assets minus or decrease current liabilities. When you pull out current liabilities that may not be appropriate, you need to add them back. I'm going to say that again, it's flipped. You add back current liabilities to the net working capital reported number, because in the reported, you actually decreased it. So it's a little bit backwards, but ultimately, that's how you arrive at the green line, which is the net working capital diligence-adjusted number. This is the key. This is, if the analysis was performed correctly, what is the gasoline in the tank that the company has needed on a 1, 2, 3 year period to keep the business running normally. From there, you'll see you can do things such as averages. So what was working capital average in 2022, 2023, and 2024? The reason why you want to come up with averages is, for example, if the company, today is January 16th, 2025, if the company had its highest revenue in 2024, let's call it $10 million. In 2023, they had $5 million of total revenue. So they had substantial growth from 23 to 24. You'll notice the net working capital average in 23 was $860,000. In the year of growth, it was $1.4 million. This makes sense. It takes more working capital to fuel a business that is growing. So what do you do with this information? If the company is expected to do the same revenues in 2025, it is fair to say you will need the same average working capital that was used in 24 to continue operations. This is the key to all of this. Once you do unpack and calculate the averages, you need to think about the business. Where was it historically? What do those averages look like? And based on discussions with management, where is it going? In my view, if the owners are very bullish on the company operations doing as well as the prior 12 months, perfect. Take the average 12 months of the last period, and that is working capital. When they have pushback, walk through exactly this approach that I talked about. The gas in the car. How am I going to be able to afford operations of the business? Working capital could be a whole conversation. So this is a great example. So hopefully it's helpful. This is a story about real dollars. You're going to get a copy of this, but I'm going to skip it. Ultimately, this is a story of a client I worked with, and we ended up saving him about $450,000 by negotiating a higher working capital. So the next piece of a critical financial due diligence is the financial statement analysis. What does that mean exactly? That specifically means reviewing the monthly income statement, whether it's in QuickBooks or another financial reporting software, and doing a line-by-line analysis of the GL accounts that make up income, cost of goods sold, operating expenses, and ultimately net income. How I like to think about doing a income statement and financial statement analysis is doing a P&L walkthrough with the company. What does that mean exactly? That is taking your reported QuickBooks P&L and doing a line-by-line discussion of, why did total income increase from 22 to 23? You'll see in the furthest column, income increased by 4%. If, for example, it was 50%, you may want to double click on why that was specifically. And I'll write just like quick notes alongside it and do a screen share. Some people might think this is overkill, but you're going to ask so many questions. It's easier to just screen share and do live, note taking. From there, you will continue going line by line and asking those tough questions, such as, why did total expense increase 28% from 22 to 23? They may not know. So what you can do is you can actually double click and go by the GL line items. And there may be one expense such as salaries or advertising expense, which is contributing to that material increase. So asking those pointed questions is how you can unpack that information. Thinking about the same approach, you will conduct a similar one for the balance sheet review. The balance sheet review, which was on that process slide, is doing a line-by-line walkthrough of what is the balance sheet comprised of, what are the changes, asking the sellers those tough questions. You'll see typically the questions you'll ask around balance sheets in these types of deals, lower middle market, small business acquisitions, are accounts receivable and accounts payable. Why is that? Accounts receivable and accounts payable are materially comprised of what is your working capital amounts. So if we flip back and we think about the net working capital on a reported basis, if in a balance sheet, for example, that looks like this, really what you're talking about is accounts receivable minus accounts payable. So during this balance sheet review, you want to understand, why did accounts receivable increase over certain periods? You'll see in November, it's sitting at $1 million. In December of 2023, it was only $300,000. You may ask questions around this. I would recommend pulling an AR aging report and understanding if there's age receivables or age payables, because those items may need to be written off or pulled out of these balances, and for whatever reason, they're still sitting there. The balance sheet review is to be held at the beginning of your diligence, because it really does answer a lot of tough questions and begins to paint the picture of what is reported, what is an appropriate level of net working capital look like. And a lot of it can be discussed when you're having these balance sheet review questions and discussions. The next technical analysis is a proof of cash and revenue. I've spoken with a lot of people who are aware of the concept. This is a proof of revenue or cash that I just completed. At the highest level, if you were to ask me what is it, you effectively take your monthly bank statements that the company can provide, and you compare the reported receipts per the bank. You pull out receipts that are non-operating in nature, which is the less non-revenue items. Think things like transfers, non-operating income, if they receive the tax refund, if they accidentally received non-revenue or non-business income to the bank statements, you would pull those receipts out to arrive at an adjusted cash receipts. The adjusted cash receipts is then compared to the reported revenue per the company's QuickBooks or financial software. One thing to note is typically the QuickBooks reports will be on an accrual basis. Naturally, your bank statements are pure cash transactions, so you will need to adjust the revenue as reported per QuickBooks and then adjust it up or down based on changes in accounts receivable. Accounts receivable are a balance sheet item. Those will either increase your revenue or decrease it. From there, you'll arrive at the expected cash receipts, which is B, expected cash receipts per revenue as reported on QuickBooks. So you're taking the adjusted cash receipts per the bank and comparing it to the expected cash receipts per the QuickBooks file. And your objective is to get that within plus or minus 1 to 2%. This I like to call, and using the F word, this is the fraud test. If the company's bank receipts are materially not aligning with how they're reporting their revenues in the QuickBooks, there's a problem. You need to have discussions about why there are discrepancies, because the risk is the revenues reported in QuickBooks is higher than cash receipts. So the risk is overstatement. On the same side, an analysis called a proof of expense, which is comparing expenses per QuickBooks compared to cash disbursements. The risk is you underreport expenses. No one wants to, if no one will over-report expenses on a company's QuickBooks because it just decreases your net income. They do that for tax purposes. That's a difference. So ultimately, this is a proof of cash or revenue analysis at the highest level. You take your monthly bank statements, you remove items in the bank statements that don't look like they're related to the business, transfers, etc., and you compare it to revenue in the company's financial software using the monthly P&L from the income statement review. A very helpful analysis. It's quite time consuming, so definitely consult a professional about it. We're about 35 minutes in, so I'm going to keep it moving, cover a EBITDA analysis and some due diligence adjustments, and then we'll close. So a quality of earnings analysis is also known as, how do we get from reported net income to a adjusted EBITDA? And the adjusted EBITDA is what you can expect as normalized earnings on a go-forward basis. So when you buy a company, the adjusted EBITDA over a 3 to 5 year period should be in line with what you can expect when you take over a business and move forward. So this is the face of a Q of E report. There's a lot that goes on in this spreadsheet, but ultimately it is taking the reported net income and the EBITDA reported from the company's financial system, and then through a series of fact finding, you propose certain due diligence adjustments, which either increases EBITDA or decreases EBITDA to arrive at the EBITDA adjusted, which is what does normalized earnings look like on a go-forward basis. Typically, due diligence adjustments all come with a brief explanation or write-up about why they were included, why they are appropriate, and what they're comprised of. So work with Q of E providers to understand why they proposed a certain due diligence adjustment, to one, make sure it's valid and makes sense, because you'll use these diligence adjustments to potentially show the sellers and owners about why a business may be worth actually less than what you've originally offered. This is a tool that is widely used in SMB diligence engagements and is a vital tool in negotiations if need be. A couple items to call out. Typically, professional fees and transaction-related expenses, such as if the company was cleaning up their books to prepare for a sale, those expenses are typically one-time in nature. So if the expense is one time, it's not expected that you'll actually have to pay for that going forward. Those are typically added back. So that's line H. Things like revenue adjustments and out-of-period refunds and other income, those are technical adjustments which warrant another discussion. But the easy ones to think about are things like automobile and truck expense. That's owner related, so it's non-business expenses. So those were added back as well. Spotting financial red flags. Here's some red flags I see all the time when I'm doing diligence engagements. Unrealistic growth projections. If the company is saying they think they did 5 million in 24, in reality, there may be items found during diligence that they actually only did 4 million or 4.5 million. There may be an underreporting of expenses. There may be expenses that were burdening the P&L that are owner related and don't relate to the business. Those would be pulled out of financial diligence adjustments. And other things like inconsistent revenue and other red flags to think about. So negotiating adjustments with confidence. If we think about the Q of E report and the EBITDA analysis specifically, confidence in the due diligence findings speak to why should a seller give you credit for certain diligence adjustments, which either increases the value of their business or decreases it. And you need to be able to clearly articulate it or hire someone who can, because ultimately these are negotiating points. Based on these discussions, you will adjust purchase price accordingly. In the industry, this is called a retrade. Typically, retrades can lead to deals ultimately not continuing and making it to close. if there's significant findings in diligence, unfortunately, the business may not warrant the price it's being listed for. But there's a variety of ways you can adjust purchase prices that can still close deals. I'm actually doing a discussion about how to structure deals and earnouts later on in a few weeks of my webinar series. So feel free to join then, where we'll dive into how to structure these deals. So if we think about step one, which was preparing and planning for financial diligence, it starts with the diligence checklist. Typically, my checklists are a single tab Excel document with about 10 requests. The first one is read-only access to the company's QuickBooks or financial software. The second is monthly bank statements. Why do I make those 1 and 2? If you are able to get the bank statements, you can perform the proof of cash or revenue and the proof of expense, which is your fraud tests. If you're able to get the company QuickBooks files, you can run the monthly P&Ls and balance sheet to perform your income statement and balance sheet review. If you only had to have, 2 requests, you could write those out in an email and you wouldn't even need the rest. I am going to provide a checklist at the end, so stay tuned. Other things to think about when you send the checklist, I always like to propose a kickoff call with, typically it's myself, the QOV provider, a buyer client, and then the seller's team. You can present them the due diligence checklist. Typically, they'll have questions about it. You have to be empathetic. This might be the seller's first time doing this. They may be a little scared and just not know what this engagement looks like. So just walk them through and be gentle with the process and explain why. Why do you need these documents and how it can make their lives easier? I always say, if you can give me the company's QuickBooks files, it'll save your bookkeeper or controller or CFO about 40 to 50 hours of pulling QuickBooks reports and emails. And ultimately, they're running businesses on a day-to-day basis, and your diligence engagement should not materially impact their operations. Why is that? If the business is declining because of diligence, stress from the owner, you may be materially hurting the business you actually want to purchase. So it's in your best interest to make this as stress-free as possible, but still get the information you need. So again, I'll share a checklist right after this, but focus on those 2 things: administrative read-only access from QuickBooks and the monthly bank statements of all cash and bank accounts open during your historical period, which is 3 years. Like I said, if you scan the QR code, it should give you access to tons of resources I offer all for free. The diligence checklist can be found in my business buyers toolkit. If you click on that button, it'll show you, fill out a form and you should be able to receive an email immediately. It'll show you my standard diligence checklist, and it'll have those first 2 items 1 and 2, and then it'll have other things. If you have questions, feel free to chat me afterward. So I'm going to answer a couple questions because we're about 45 minutes in. Which of these are you doing before LOI and after? I'm going to keep going down. If you did post that, if you could just be more specific. What kind of financial diligence are you doing before LOI? That's a great question. Typically, you need to do a high-level review of the company financials and maybe even put together an SDE number or an adjusted EBITDA number that you think makes sense, because ultimately you're going to be submitting a bid on what you think the true earnings are of the business. Let's see what we got. Someone wrote, does debt-free exclude accounts payable? So accounts payable actually don't meet the definition of debt-free. Debt-free, typically cash-free, debt-free. Debt-free items are short-term lines of credit, SBA loans if they're sitting in current liabilities. Those typically are the debt-free items you'll pull out immediately. You may have adjustments around accounts payable. Let's see. Someone wrote, the person about the payroll considered a current liability. It's a pretty detailed question. I'll do my best to answer it after. In short, typically payroll items are current liabilities. There's some nuances around working capital, but I'm happy to answer after. How should we approach financial diligence if the company's on a cash accounting basis? So you can do diligence on cash basis companies. I do it all the time. Ultimately, you want to verify the earnings of the company. If the only reliable piece of data is from the cash basis QuickBooks files, use those for diligence. More often than not, small businesses aren't doing accrual accounting correctly anyway, so it might actually be cleaner. From there, you can convert the cash to accrual basis records, with a professional or yourself. But that's something I see quite often. Katie Bishop wrote, is the bank statements versus QuickBooks comparison typically included in a Q of E package purchased from an advisor? I can't speak to any other advisors, but all of my Q of E packages include a proof of cash in the scope of work. Someone spoke about budget. All budgets are based on a specific deal or project, so I actually can't speak to that. Two questions from Ryan O'Neill. He writes, two questions: request admin view only access for the last 3 years and all cash bank accounts open. Does this include credit cards, etc.? Credit cards, there may be statements. For purposes of the proof of cash, I would keep it simple and start with the operating cash account of the business. So if we look at the balance sheet on a reported basis, it'll typically show you breakouts of the cash, such as, if there's a Chase operating cash account, and that's the main operating account of the company, I would start there, and then etc. Basic due diligence for e-com deals under 200,000, and I'm gonna assume that's enterprise value. These fundamental 5 procedures should be performed on any size deal. It could be for $100,000 or $100 million. I've worked on both. All 5 of these analysis and more are always included because those are the core components in order to verify the company financials. Somebody asked about, can you review different packages? In terms of a Q of E package, all packages are based on specific companies. I'd recommend reaching out to me or my team when you have an LOI signed, and I'd be more than happy to discuss over a discovery call. Those were all the questions. If I didn't ask them, feel free to chat me or send me an email, and I'll keep it moving. We kind of talked about the benefits. These are just a couple more. Really, it ensures there's a fair valuation of the business. And you want to, throughout diligence, minimize risk to the extent possible. You are purchasing a multi-million dollar business or transaction with real SBA loans, maybe a personal guarantee. You need to understand and verify the earnings of the company, because that's ultimately the multiple you're paying on. If the business is doing 500,000 in net income, but it really is 300, you're overpaying. And when you step into the shoes as a new owner, if the business is performing at a $300,000 level, the risk is you actually can't make those debt payments. And that could lead to closing of the business, defaulting on the loan. There's so many real issues about overpaying for a business and not understanding the earnings. You need to align yourself with partners and do the work before you sign in the purchase agreement. This is a debt and liabilities assessment. This kind of speaks to evaluating the balance sheet debt items, things like lines of credit, other debt obligations, loans, maybe there's leases. Understanding the liabilities of the company is critical, and even more important depending on the structure you choose. Tax compliance. This falls under the tax diligence. And really, you want to understand the tax compliance of the companies at the federal, state, and local level. The reason why is if there are material issues of they didn't file certain reports correctly, you could have significant post-acquisition legal and financial issues, which you want to know ahead of time. These things could be IRS penalties if you're not doing payroll tax correctly. We have a team of tax diligence experts who only do this for a living. So if you think you have issues like that, speak with me and I can point you into the discovery call with one of our tax pros.